So what have I done over the last 3 years is the first years I spent talking about how technology is changing the world of finance. The second year was about the big ideas of finance. Unfortunately, that holds in a perfect world, a world where everybody's rational, everybody follows mathematical formulae, everybody quite unlike most of us. So this year's series of lectures is on the human side of finance. What happens when we ask other people to do things for us? What happens when we have conflicts of interest? And where do these conflicts arise? And I'll talk about it in a series of lectures. Each lecture will be devoted to one topic. So for example, today's topic is about money. Let's start with the question of what is finance? Why do we need it? Well, at its core, finance is just about promises, right? Everything in finance is about promises. What are these promises? The promises is somebody comes to you and says, give me some money right now. And in return, I will give you some fantastically large amount of money in the future. The question is obviously, what are these promises worth today? That's what you have to decide. So essentially, finance at its core is about moving money through time, right? So money today, is that equal to money 1 year from now? Is it equal to money 10 years from now? That's what finance is all about. The first problem we have, and this is what I addressed last year, is can I figure out the present value of that promise? I need to compare it to the amount I'm actually going to invest. So this is all about what is the present value of all those things in the future relative to the price which I'm paying today. And we have a whole bunch of tools which we teach MBA students, which we teach Master of Finance students. I spend a lot of my time doing is to train our students to try to figure out what is the present value of a promise. We use tools like discounted cash flow, we use capital asset pricing models, we use different types of models, but at the core, all of that assumes that people are rational. In reality, there is a human side of finance, which is you get a promise, but how do you know that person is actually telling you the truth? Are they perhaps lying to you? And there can be two ways in which they lie to you. One is, of course, deliberate lying. It's basically fraud, right? If they're lying to you and they're deliberately trying to take advantage of you in order to take money away from you. But there's also a second one, and that's what I want to focus on in this series of lectures. The second one is something called incomplete contracts. What that means is, if I have a contract which is incredibly long and incredibly complicated, if they can read that contract better than you can, they might be able to take advantage of terms of that contract to rip you off. Even though you have the contract in front of you, there's nothing hidden. It's just that our ability to process that contract is less than the ability they have to process the contract. So in other words, is there something in a contract that allows them to take advantage of you legally? Right? It's nothing illegal about any of this, but we'll see examples where what you expect may not be what you actually happens. So let's go back to something I talked about last year, which is the basic cycle of finance. When I said this, what I said was there are two parties involved. Party number one are firms. Firms need money. They invest in a bunch of assets, but they need money to do that investment. That money comes from investors. So the firm basically makes promises. This is what our project should be worth. This is how much I'm going to generate for you. And then you issue securities. You issue, for example, bonds, or you issue shares. The market values these securities and gives the money to the firm. The firm then invests, generates some cash flows. Part goes to the government, taxes. Part is retained by the firm, retained cash flows, and part of it comes back to the financial markets in the form of dividends and debt payments. That's the basic cycle of finance. But now I want to ask a question here, right? I'm only talking about two groups of people. I've got the firm, I've got the investors. But the finance world is much more complicated. And the reason it's so complicated is because there's an enormous number of people sitting between the investors and the firm. And those people are called intermediaries. Right? And this series of lectures will be all about the different types of intermediaries. We're talking about banks, we were talking about insurance companies, we were talking about hedge funds, mutual funds. How do these intermediaries create value. So the first one is they match the two groups of people, right? For example, the firm invests in assets, but the investors don't know which firms need the money. So the job of the intermediary is to match the people with the money, the investors, to the people who actually need the money, the firms. They also change the maturity of the deposits. For example, the firm needs money for a long period of time, but if you deposit your money in a bank, you might want it back in a quick and short period of time. So that's a short maturity converted to long maturity. There again, it's about changing money through time, right? So you have short-term money be converted to long-term money. When you come in there and you say, all right, what is it that the investors actually want? So to put that into a more formal context, I'm going to call these people the principals. Investors, in my world, are principals because they are the people with the ultimate source of money. Okay? They want something done. What do they want done? They want to earn returns. They want to make money with the money they have invested. Okay? So they hire somebody else to do that. We call that the agent. And the agent's job is supposed to do the work for the principal. In this particular case, find good opportunities to make money. The principal, unfortunately, does not have either the expertise or the information the agent possesses. So that's one of the reasons why the agent can take advantage of you, because they know more or they're more of an expert than you are at a particular thing. And the problem essentially is of asymmetric information. They know more than you do. So how does that show up in contracts? So let's start by identifying who are the agents in that simple diagram I showed you, right? Who are the agents here? The first agent is the bank. You give your money to the bank. The bank is supposed to keep your money safe, but they lend the money on to other people. That's one. There's a mutual fund. If you invest your money with a mutual fund, the mutual fund is supposed to find opportunities for you, or a financial advisor who will tell you which mutual fund to put your money in. If you're very rich, you might use a hedge fund, right? So also invest your money. Or if you're extremely rich, you might use a private equity firm, but they're all agents. Their job is to do something for you, find the best opportunities. And of course, at the end, you also have the manager who does the actual investing. So in each of these lectures, I'll focus on one or two of these groups, and I'll say, okay, what's going on here? Today's talk will be about money. So it'll be about the bank. Where does money come from? Where the issues are with putting your money in a bank. So how do you make this agent work for you? You got the bank. How do you make sure the bank is doing stuff in your interest? Well, there are three ways. The first way is an explicit contract. It's something that's enforceable in a court of law, right? So you put your money in a bank account and the bank does not give you the stated rate of interest, you can sue them. Anything which is written in a contract, which hopefully you understand, you can take advantage of it and sue them. However, there is a second thing, which are legal regulations. For example, banks are required to insure the deposits by paying money to an insurance company who will pay you in case the bank goes bankrupt. There's also an area of fiduciary responsibility. This is also ideally something which says they are supposed to act in your interests, not in their own interests. If they recommend a financial instrument to you, it's supposed to be best for you, not what's best for them, not makes them the highest margins. But underneath everything else, there is the idea of implicit contracts. You need implicit contracts because explicit contracts are never enough. And let me explain why. Let's go back and also to some concept I talked about 2 years ago. And this one talks about when implicit contracts make sense. In this world, before the 1700s, before the Industrial Revolution, most people never left their village. They're born in a village, they grow up in the village, and they die in the village. So, in other words, you have constant interactions with the same group of people again and again. You actually don't need a contract, right? You know who the best butcher is, you know who the best baker is, and presumably you know who the best candlestick maker is, right? But you don't actually need to write a contract with them The fact that everybody knows everybody means that you can figure out a good butcher, a good baker, or a good candlestick maker. But in the Industrial Revolution, one of the big things that happened was high fixed costs. That means if you want a weaving loom, you need to increase the scale of production, because otherwise the weaving loom is too expensive for one village. There are not enough people in the village to employ a weaving loom to the fullest. So you need more people, you need a higher volume, you need a bigger scale. And where do you get that? Well, you go into towns. The thing with towns is you don't necessarily know everybody in a town. Cambridge, for example, is probably a town. But you do bump into people again and again. Right? You're like, okay, I know these people. You repeatedly interact with a few groups of people. So you do trust local authorities. You know your postman, you know your police officer, so you keep repeatedly interacting with those people. But as scale increases, once you go to the Revolution 2, it becomes even bigger. You need cities. And unfortunately, in cities, the problem is nobody knows anybody else. In that world, you still trust some intermediaries. You trust your bank because you know the bank manager and so on. But as you go even beyond that, all these banks are interchangeable, right? We don't know what's the difference between one bank and another bank. And I'll give you worse examples of that in a few minutes. But there you trust the system. You say, okay, if any one bank fails, the government will give me back the money. You trust that. And of course, today, it's even bigger. So maybe technology will save us. I'm personally skeptical, but that's the idea. But anyway, the key question here, the key part here is all those things work because in the first case, trust works because you're repeatedly interacting. In big cities, trust does not work because you never see the people again. That's it, right? You see the person once and you never see them again. So you need to replace an implicit contract with an explicit contract in some way. Let's take an example of an explicit contract. For example, maybe you're considering investing in an umbrella company in Cambridge, right? Now, the manufacturer promises to double your money in 4 years if the weather is bad over the next 4 years in Cambridge, right? Otherwise, you lose 20%. Would any of you invest? Remember, this is England, so it's probably going to be bad weather most of the time, right? But Cambridge is the sunniest part of England, apparently. I haven't really noticed much of a difference, but really, it is the sunniest part of England. At least that was what I was told when they hired me from California to come to Cambridge. I maybe shouldn't have trusted that promise. But coming back to this, how many people would say, this is a good investment? Anybody? Double your money in 4 years. Otherwise, lose 20%. Anybody? Show of hands? Nobody? Okay, one hand there, few hands here. Okay, some there. Okay, excellent. The problem, of course, is suppose you invest in this company. And then 4 years later, you say, where's my doubling of the money? And the guy said, well, the weather wasn't bad. I said, what do you mean it wasn't bad? How long a period does it have to be bad? It was bad for 3 months. 9 months was wonderful. So what does being bad weather want? Right? You need to be more specific. Maybe it has to rain more than 250 days a year in order to consider the year as bad. But that's not enough either. What happens if it's a drizzle versus a dampness in the air versus a deluge? I mean, what defines bad weather? You have to go more and more into details of the contracts before figuring out that you really can never, even in a contract like this, there's no trust because you cannot specify the details in excruciating detail. Right? So the problem is lack of information. So we have 3 types of information problem. Problem number 1 is, of course, imperfect information. You don't know what the weather will be, but neither does the umbrella company. The second one is asymmetric information. The umbrella company tells you this is a wonderful umbrella, but you don't know anything about umbrellas. Is it a good umbrella? Is it a bad umbrella? I have no clue. So that's asymmetric information. The third one is a behavioral issue. You really think you know British weather well, and so you think, oh yeah, definitely bad weather, but global warming, we don't know whether maybe this is going to be the Riviera. We don't know in a few years. So how do you write a contract here? So let's take some examples, non-finance examples, and then we'll go to finance. Think about grocery shopping. What is your most energy-intensive organ in your body? It's your brain, right? The human brain is by far the most energy-intensive organ in your body. So let's correlate that question with the next question. If you think about people with terrible diets, what's the highest amount of correlation found with income? Is it a positive correlation? That means rich people have bad diets or poor people have bad diets? Mostly, it's a positive correlation, which means that the richer you are, the better the diet you usually have. But why do poor people have terrible diets? Don't they know that salad is better for them than crisps? The answer is there is a difference between when we go grocery shopping and when they go grocery shopping. When I go grocery shopping, for example, I don't really think that much of the prices I'm paying. It's like, okay, I need milk, I need whatever, so I may have some preferred ones, but I put it in my basket and I walk out. I don't think twice about it. I'm not really using my brain very much. But someone on the edge of poverty was basically saying, wait, if I have milk, that means I have to pass this up. You're constantly making decisions about how much you can afford. So by the time you get to the checkout counter, you're so exhausted, it's much easier to have a quick energy fix. Carbs, basically crisps, are way better for giving you a quick jolt of energy than salad. And of course, that's also why the supermarket puts all the sweets and the snacks right next to the checkout line, right? Because that's where they know you're going to reach for it while you're waiting to check out. They may not necessarily know why they're doing so, but they do know high sales. That's where the sweets are, right? That's an example of a type of conflict, right? It's perfectly legal to do that. But the point is, they're trying to say, okay, I know behaviorally this is what you're going to do. So I'm going to try to take advantage of that. Is that the right thing to do? Well, it leads to obesity, it leads to all these other things, but they don't care, right? Because at the end, it's about sales. Or let's take eating out. There is a whole science to menu design. In fact, restaurants in America classify you on a scale. There are apparently 4 types of diners in American restaurants, and I do recognize some of these myself. They're called entrees, who don't want a lot of description. They want the bottom line of what the dish is and how much it's going to cost. There are people who call recipes, who ask many questions. They want to know as much as they can about the ingredients. There are people called barbecues who share food and they like chatty servers who wear name tags. And finally, there are people who are called desserts, or 20 people who want to order 20 things, right? So there's a whole classification system for people who do these things. But anyway, the point is, once I know what type of person you are, I can design my menu to suit you, right? Because this is the kind of person I'm trying to attract. But there are some general principles. For example, if you think about wine at a restaurant, which wine should you order? Well, most people do not order the most expensive wine unless they're on an expense account, right? But they don't also order the cheapest wine because they don't want to look cheap. They order the second most expensive or the third most expensive wine. But interestingly, that is also the wine that has the highest markup. So the one with the lowest markup is probably the most expensive. So you're getting more value for your money if you go for that one, or the really cheap one. The one which you buy is giving the maximum profit to the restaurant. Similarly, anchoring. You see some parts of the menu which is super expensive. Why? Because relative to that item, everything else looks cheap. So you have a few things which no one's going to order. But, people are like, wow, that's so expensive. Oh, this is a bargain. Let me order the steak instead. Similarly, signs. Putting an actual pound sign or a dollar sign on the menu, big no-no. Simply because people are reminded that they're actually spending money. You don't want any memory of that, right? Even like, you want a discrete thing. Ideally, you don't want numbers on the menu at all. Right? And we see examples of that as well. Should you have $10, $9.99, $9.95? Definitely not 10. $9.99 and $9.95 is better. $9.99 is too close. People know this trick already. $9.95 is a good number. Close enough to 10, but people are sort of, oh, okay, this is cheaper than 10. And of course, Starbucks. All of us go to Starbucks. You notice the signs, the sizes in Starbucks, right? They have grande, they have venti, right? And they have a tall. The tall is the small one. And of course, the reason is because they were trying to compete with McDonald's. And if they have small, medium, and large, everyone will compare the prices. Small at McDonald's, much cheaper than a small at Starbucks. But if you call it a tall, people are going to compare it to the wrong item. And so grande sounds big. It's a medium, but it sounds big. And venti is my favorite. Venti is an Italian word which means 20. It's not a size, it's a number. But why have it? Why does Starbucks have it? Because Italian, it's an Italian number. Italians make good coffee. So they're like, oh wow, this is Italy, they make good coffee. We sound foreign and exotic when we order a venti. Let's go to one more example. Entertainment. Think about art, right? What is art all about? Well, if you think about the Mona Lisa, when you first saw the Mona Lisa, what was your impression? How many of you said, wow, this is the most amazing painting I have ever seen? How many of you were a little underwhelmed? I see a few hands going up, right? I was underwhelmed as well, right? So why is the Mona Lisa so famous? It turns out it was not. The reason it became famous, but people would just actually, when the original painting was hanging in the Louvre, they would walk right by the Mona Lisa to get the Michelangelos and the Raphaels, which are much more impressive, in the next room over. But in about 1917 or so, an Italian called Perugia stole the Mona Lisa. He just bundled up under his arm. It wasn't protected, wasn't famous, took it and disappeared with it. And it turns out more people came to see the empty space on the wall that the Mona Lisa was hanging than people who had actually come to see the painting. And when it was stolen, when he was eventually recovered, he was arrested, he was recovered, they brought it back, and they asked him why he had done it. He said, because this is such a sublime Italian painter. It cannot hang in France. It deserves to hang in Italy. And people loved the story. And so the Mona Lisa is famous because it is famous. Okay? Or Duchamp. If you take Marcel Duchamp's artwork, this is my favorite piece. Is this art, right? It's his famous pissoir, which is basically took a urinal. He said, I call it art. That's why it's art. So if you think about what is art, there are two approaches. One is to think of it as a beauty. The other is to think of it as a signal, right? It's like, you don't know anything about me, but I'm a man of discerning taste. How do I know? How do you know that I'm a man of discerning taste? Because I can see that and I can say that's art. If you don't think that's art, that's because you're Philistines. That's essentially what it is, right? So the more difficult art is to understand, the more it acts as a signal. That's the idea here. It's a signaling story. Now, let's go to finance. When we look at finance, how do banks add value? We've talked about two things. We've talked about matching borrowers or lenders. We've talked about transferring maturities. But banks also provide liquidity and they take risks in assessing creditworthiness. So let's look at that structure. How did that structure evolve? What happened before there were banks? So let's go back to Mesopotamia in the 18th century BC. No banks at that time. They were just merchants trading with each other. So what did the merchants do? The first thing that you have to understand at that time was money is not the kind of money we have now. Money was physical. In other words, it was a unit of weight, what you call a shekel. Now, everything was in terms of weight, how much physical stuff you could exchange for more physical stuff. For example, the price of 3 costs of pure oil is 1 shekel of silver. Of course, silver is expensive, so if you want lower items, you would express it in shekels of barley. Right? But at the end of the day, what you're doing is there is no abstract element. It's just physical. You can see, you can touch it. And of course, transactions and financial forecasts were kept on lists. Who owed money to who? One of my favorite pictures is this one here. This one is taken from a book by David McWilliams called Money, A Story of Humanity. Highly recommend it if you haven't read it. But that is an example of an Excel spreadsheet from the 18th century BC. What it does is to forecast how this business is going to be harvesting barley over time. And so that is a classic Excel spreadsheet from 1800 BC. Nothing different today. So at the end of the day, it's all batch processing. So at the end of the day, or the end of the month, people would settle up. okay, you owe me barley, he owes me silver, we settle up in a batch processing process. But interestingly, one of the innovations here was that you didn't have to settle in the original unit of account. So for example, if he owes me barley, he can settle it by giving me a slave or something else, right? So basically, equivalent units will also count. But how do you control the merchants at that point in time? Well, it turns out at that time they had explicit regulation. What was the explicit regulation? The classic example is the Hammurabi Code. The Hammurabi Code is a detailed series of laws which govern every aspect of life in Mesopotamia. This is taken from Wikipedia, but these are the laws for commerce at that time. There were loans and trade, there was innkeeping, there was fraud, and so on, and detailed descriptions of exactly who is liable for what if a transaction goes wrong. But none of this is anything but banks. This is all still merchants. So when did the banks start as banks? The answer has to wait for a bit, and in fact, this is Firenze, Florence, in the 1300s. And what is interesting about Florence is there are two roles to what the banks were, what the financial institutions of the time did, and one of them is new. So two old rules. What was the first old rule? Pawnbroking. So pawnbroking is pretty standard. It is basically you take in a physical asset, right? You're hawking your jewelry, for example. I take in a physical asset and I give you money. Okay? So that's a collateralized loan today. The second one is money changing. You give me one type of currency, I give you back another type of currency. Now, interestingly, the second one is unusual because that's what gave banks their name. The word bank comes from the money changers who would set up their benches, banco in Italian, on the Ponte Vecchio. So you'd sit on the bench and, change money from person to person. What's also interesting is if you lost somebody's money or you charge them wrong amounts, they would take away your license. Basically, what they would do is take away your bench, your banco, and break it physically. That's where the word bankrupt comes from. It's a rupture of the banco, right? So basically, bankrupt comes from the money-changing rule. But that's not, these two are still stuff which has happened, which had been happening since the 18th century BC. Nothing new about this. The interesting part was number 3. Number 3 was fundamentally different from pawnbroking and money changing. It was first working capital financing. Farmers need seeds, they'll harvest, they'll give you back money in the future. Wool weavers reading raw wool. Part of that was also there in Mesopotamia. But things about capital investment, which is essentially you give me money now to make an investment, and when you generate money from the investment, you will give me back cash flows in the future. These two were fundamentally different from the first because they involved that fundamental aspect of finance, which is moving money through time. Right? I'm promising to give you money in the future in return for money today. And by the way, that was one of the reasons why the church had big sanctions on interest, because the key idea there was simple. Right? What you're doing is you're putting a value on time. You're saying money 4 years from now is different from the value today. But only God can put a value on time. If a human being is putting a value on time, you're usurping one of the privileges of God. So this is blasphemy. That was why the church for a long time had prohibitions against usury. Basically, you're trying to take away God's prerogative of putting value on time. Of course, the merchant bankers didn't let them stop him. They would come up with all sorts of ways to avoid being seen to pay interest. For example, I buy an asset from you, and I give you buy it back from me at a higher price 1 month from now. Basically, the difference in the two prices is a repurchase agreement, and the difference is the interest you're actually paying. So there are lots of ways to get around it, but the idea is exactly the same. But that meant that you had to transfer assets from one merchant to another. Of course, the easiest way is physical transfer, just like in Mesopotamia. But a more interesting thing happened when you didn't need to transfer the actual assets. you could transfer documents showing the transfer of assets from one person to another. So first such was a letter of credit. You write a letter, basically you go to your bank issues you a letter, you then take the letter to a different bank who will then pay you the money accordingly. This was first, one of the biggest uses for that was during the Crusades, because when you want to go on the crusade, you need armor, you need weapons, you need horses, they cost a lot of money. You can't take them with you from England, so what you do is you get a letter of credit written by your local bank, you give it to the bank in Jerusalem, they give you weapons, and then you can smite the enemy. Of course, that became checkbooks, but the most interesting thing happened when they actually became money. That means, in a sense, what was happening was, this is now a piece of paper, which basically says, I have this asset with this bank. But now I can sell that piece of paper to somebody else. That somebody else can sell it to somebody else. Effectively, the person who ends up with it is someone who had absolutely no direct connection with the bank. It's just pieces of paper being traded in a system, somewhere nebulously connected to some physical asset. Right? So that was what we call virtual money. So when you think about it, how does the bank make money? What is the process? The first one is, the key realization was, if you deposit your money with a bank, you typically don't withdraw your deposits. You have it on a regular basis. So as long as the bank keeps a reasonable reserve of cash to meet sudden withdrawals, you can lend the rest of the money to other people at high interest rates. Right? And of course, the process is, once you lend it to somebody else at a high interest rate, that person puts it into a different bank while they wait to use that money in some other way. So essentially, you keep rinsing, you keep repeating, right? So that's the process. So initially, the banks were private. It was not a government bank. There was no deposit insurance. There were no guarantees. There was no explicit regulation. So how do you trust the private banks? The answer is signaling. So if you think about the older banks in the world, they had massive buildings, right? Big Corinthian columns. They looked like temples. The idea was, we are safe, we are trustworthy, you can deposit your money with us. Look at that. Look at that solid institution that stands behind us. If you go to the Bank of England, that's an example of signaling. You see that massive building over there. But that also meant that you could now depend on networks. The more faster you build up your network, the more the money becomes accepted. That means your piece of paper will be accepted anywhere else because people trust your bank. They trust your name. The Rothschilds, the Barings, all these examples. And eventually, it becomes a network effect, sort of like Facebook. People are on Facebook, in many cases, not because they like Facebook. That's because all their friends are on Facebook and you cannot get away from Facebook. Same thing with a bank, is that you have to be a depositor at a particular bank, not because you like the bank, because the bank has the biggest number of networks around the world. But that also broke the link between power and money. Till then, money was power, right? Basically, it was fiat money, which meant the king said, this is the only money that's allowed. It's a piece of metal with my face on it. If you try to put anyone else's face on it, I cut your head off. So that's basically a strong network, but it's also fragile outside the domains of the kingdom. The same money will not be accepted in the next kingdom over. In contrast, virtual money is a weak network, but it can spread everywhere. It doesn't matter if a banker dies. The network still stays there. It's a little bit like the internet versus one point of access, the king. But the problem with virtual money is simple. Bank runs. Which is, if you suspect, we're talking about private banks, right? If you suspect that a private bank doesn't have enough money to pay you back, what's your incentive? To be first in line to get your money out, right? But that means even if the bank is perfectly solvent, it can still lose everything because everybody gets in line to take the money out, which the bank does not have. So how do you solve bank runs? Well, one way was deposit insurance. That's a legal regulation. So the government says, you know what? Every bank has to give money to a deposit insurance corporation in order to guarantee all the bank runs. So if the bank fails, The FDIC in America will pay you back the money. Fine. So that's an explicit regulation trying to solve the problem of bank runs. The problem, of course, is that creates problems. So what are the problems that deposit insurance creates? The answer is, now the bank knows the government is going to bail out, or the Deposit Insurance Corporation is going to bail out the people depositors. So I can take lots of risky loans. I can raise interest rates. I can make loans to anybody who's offering me a high interest rate because I can make the money. So that's called moral hazard. The bank increases the amount of risky borrowers it gets through the system. However, that creates problems. So how do you solve that interest rate problem? Well, one way is restrict interest rates. In America, they use something called Regulation Q, which still lasted till 2020. It's still there, some parts of it. So Regulation Q first started out by saying no interest allowed in demand deposits. That was solved only in 2011 was that repealed. They had other things. Interest rate ceilings on other deposits as savings and time deposits. That was repealed in 1986. And there are limits on money market account withdrawals. So that's suspended in 2020. It hasn't been reinstated yet, but it hasn't yet formally been repealed. So the answer is, please restrict the amount of interest you can pay. Unfortunately, that creates a problem. So the problem here is, I don't have to give you interest once a year. I give you interest every 6 months. That's a higher rate of interest than once a year. Or I can compete by giving you interest every 4 months, or every quarter, or every day. Effectively, I am giving you a higher interest, even though the interest rate is fixed by the government. So how do you solve that problem? Well, you restrict the amount of assets the banks can hold. This is the current state of the art. The Basel Accords are for this, and they have a whole bunch of rules. Tier 1 capital, Tier 2 capital, and they have all these rules saying the well-capitalized bank has this amount of capital ratio, Tier 2 capital ratio, and so on and so forth, right? And now there's a new version called tangible common equity. It includes preferred equity, and everything is about, I'm going to restrict what you can hold. This tries to solve the credit problem. The banks are lending out money to unsuitable borrowers. But then some people argue that the problem here is short-term deposits are matched against long-term loans. That's why there's a problem. Other people say, no, wait, a bank is not matching deposits, it's matching depositors. And what's the difference? The difference is most depositors don't have a clue, right? Most depositors are also, I apologize to everybody here, lazy, right? So for example, I have a bank account at Barclays. Is it offering the best I can find? No. Why am I with Barclays? I'm lazy. Right? I don't want to get to all the things, changing my direct deposit, doing all that stuff. I'm like, forget it. I just keep my money there. So the bank is basically saying, I have long-term loans and have long-term depositors who don't have a clue what is going on, because they know the money is protected by deposit insurance, so they really don't care very much about the quality of the stuff they get. So in this case, there is no credit maturity problem, but there is now an interest rate mismatch problem. The classic example is Silicon Valley Bank last year. So what happened with Silicon Valley Bank? Well, Silicon Valley Bank, turns out it took money from tech companies. Now remember, you have to have borrowers and you have to have lenders. So the lenders were tech companies, but the borrowers, right, what does it invest the money in? Unfortunately, the tech companies were extremely well funded by venture capitalists. They didn't need the money. So these guys had no way to invest that money. So they bought long-term government bonds, completely safe. Unfortunately, the Fed raised interest rates. So those bonds lost value. Now, if those bonds had been held to maturity, the banks would have got all their money back because these are government bonds, completely safe. But the problem was, from an accounting perspective, to make the banks safer, they were required to mark their assets to market, which meant you had to report the market value of the assets you were holding, not the book value. So what would happen? The moment you start reporting that the market value of the assets you're holding has dropped because of interest rates, these are tech companies. They're smart, right? They're also extremely socially connected. All of them basically started pulling out their money right away. The bank went bankrupt, it was failed, it was taken over by the government, customers got their money back, but the government lost a lot of money. Okay? One solution to that was, wait, these guys are all digital banking, right? So get rid of the digital. Make people actually physically go to the branch in order to withdraw. That might work, except, of course, now you have a signal. You see a long line of people waiting outside a bank. You're like, what's going wrong with that bank? Maybe I should withdraw my money. So there is never a clean solution to all these things. Bank runs are contagious. Why are bank runs contagious? Well, problem in America is that most banks have exactly the same name. For example, this is a bank called Pacific West Bank Corp. It was a small lender based outside Portland, is trying to distance itself from another one called PacWest Bank Corp, which is experiencing a bank run. People thought it was the other bank. Or First Republic is not, Republic First is not First Republic. They're totally different banks. But the guys are basically, withdrawing the money from the wrong bank because they read about this. Matt Levine at Bloomberg experienced this best when he said the biggest risk to the US banking system is that there are 4,000 banks and they're all like 6 names. My favorite example from Matt Levine is Amalgamated Bank announces agreement to acquire Amalgamated Bank of Chicago. Right. Apparently, the really ironic part was neither bank was amalgamated from other banks. They were actually bought because they were from unions, like the Amalgamated Clothing Workers and so on and so forth. They were not amalgamated. But 2 non-amalgamated banks called amalgamated banks merged with each other to form an amalgamated bank. I mean, it's confusing even talking about it. So what is the government reaction? More regulation, right? So, for example, they have earnings at risk, they have economic value of equity, all sorts of new regulations. But another way to solve these problems, these conflicts, is to get rid of this lending business altogether. Narrow banking. The narrow banking process is, I'm holding customers' money without investing it. That means there are no bank runs, there are no losses. All I do is I give my money to the government, the Fed. The Fed pays interest, so banks can cover their costs and pay the customer some interest too. And the narrow bank is simpler and cheaper to run than regular banks, so it doesn't need physical branches. So, but then who makes the loans? Well, the answer might be individuals, people who like making loans, right? So we find investors give money to this fund for 10 years, the fund uses the money to make 10-year loans, and after 10 years, they get back whatever is left over. Now, if things go bad, the investors lose the money, but they know they're on the hook to start with. It's not like depositors. We need the money to buy stuff. We don't need the money to make loans. These guys know they're making loans, and that's why it seems like a safer system. Interestingly, this is already happening. Let's take a look at an example. This one here is what's happening with Main Street banks in America. Nobody puts money into Main Street banks anymore because the interest rates are so low for the banks that people are putting them into money market funds, which have offer much higher interest rates. But who's making the loans now? Answer, private equity. So basically, these guys coming in there and they're lending against assets like equipment and automobiles. And so they say, we are now making loans in place of banks. No, there's no disclosure here. How do we know that these guys are safe? But maybe one way around this is by eliminating public money. Let's call it private money, stablecoins. Right? So stablecoins are coins which are supposed to maintain their value at $1 or £1 or whatever, 1 unit. How do they do that? The same way. They invest the money, they keep the profits, make risky investors succeed, they earn more, they lose all the money, depositors suffer more of the loss. That encourages them to take risk with their money, which means in a stable coin, you have just the same risk as a bank run as a regular bank run. However, the point is, even if they invest in safe things, some investments are long-term. And so if everyone wants some money back at once, they might not have enough cash, and they might have to sell investments at a loss. Same thing as the banks. Now, let me give you an example of a company, Tether. Tether is a stable coin which promises to keep the value of 1 unit at $1. But what it does is, it turns out, it lent its money to another company called Bitfinex, and the story is actually quite weird. It turns out that they kept all their money with a Panamanian entity called Crypto Capital to actually process the transactions. They had placed over $1 billion of commingled customer and corporate funds with Crypto Capital. Right? And they wanted to get their money back, but Crypto Capital was not giving it their money back. So they would write plaintive emails like, hey, sorry to bother you every day. Is there any way to move at least $100 million? We are seeing massive withdrawals. We're not able to face them anymore unless we can transfer money over crypto. Or even better is up there, right? Hope you'll be able to send something pretty big pretty soon. The situation is not looking good. It was July when you told me for the first time. We were supposed to expect it every time. Or I think you should stop playing and tell me the truth about what's going on. I'm not your enemy. I'm here to help you. I've been very patient so far, but you need to cut the crap and tell me what's going on. I mean, what's happened essentially was pretty straightforward. It turns out Crypto Capital told them, look, we can't give you the money. Why? Because the money has been seized by the US government for illegal transactions. These guys said, wait a minute, the US government hasn't seized your money. You're just stealing your money. They said, no, US government did it. No, you're stealing your money. And so what they essentially did was to give them a loan. I'll talk about that loan in a bit. So basically, Bitfinex used Crypto Capital to process customer payments. They had $1 billion with this company which nobody knows anything about. Crypto Capital stopped returning the money. Bitfinex couldn't pay customers who wanted to withdraw, so it took $625 million from the Tether bank account. They said they exchanged it for $625 million in their Crypto Capital account, but the money in Crypto Capital may have been gone already. Nobody knows. That meant that Tether stablecoins weren't backed by real dollars anymore. They called it a loan, but it really not quite a loan. The problem is Tether is trying to keep its money constant, but nobody knows where the money is really there. So how is Tether solving its problem? By not telling you anything. Like, we cannot tell you anything, because if we tell you something, you'll know we don't have the money. So we're going to have our accounts audited, but not today. It takes time. So this is the difference, in effect, between money and finance. Money, when you think about it, is based on trust in the government, fiat money. But the money I've talked about now is virtual money. It's private money. It's money that doesn't actually exist. So the first type of money is the currency, which is the stuff we have in our pockets. It's backed by gold or government guarantees. Finance is created by banks and governed by commercial law. And all the money innovations have been happening in finance, not in currency. And this is huge. Only 10% of our modern money system is physical cash. 90% of them is forms of finance. So this is what we call money creation by banks. What does that mean? Well, the traditional view is nice, right? The central bank decides how much money the economy needs. It creates, it prints money, pushes the money to commercial banks, and the banks then push it into the economy by lending. This is great, right? It's logical, it's easy to understand, puts the central bank in control. Everybody thinks, oh, I know that somebody's in charge, right? And experts are managing the money supply. There's another theory called the pull theory of money. The pull theory of money says people want money to do something, buy a house, to do something else. They ask for the money. The bank gives them the money. But how is the bank giving them money? Where is that money coming from? The answer is, think of a mortgage loan. The bank, when you apply for a mortgage, all the bank is doing is taking your asset, your house, contract to your house, and creating an account on its balance sheet. Right? Basically, you have an account. It's a liability for the bank. But the loan is the bank's asset, the deposit is a liability. You get the house, the seller gets the cash, and the bank gets both a new asset and a new liability. There is no actual exchange. There are two new accounts being created. That is much, much more than the amount of physical value underlying the house. So, how does the government control the money supply? Government sells treasuries, which are IOUs to commercial banks in the markets. The Federal Reserve buys those treasuries in the open market, creates deposits, which are reserved for commercial banks in America at the Fed, at the Bank of England here. And the reserves are only created by central banks. And you've got to have a reserve account for that, right? And used for transactions and so on and so forth. In reality, the bank sets a short-term rate. And the long-term rate is the short-term rate plus a premium. So what happens? Well, what happens first of all is financial experts try to predict the central bank decisions. They read the papers, and if you open the Financial Times, they're saying the Bank of England is expected to make a cut of 0.5% next week. They're guessing. They don't know what's going to happen. But the central bankers are guessing the economic trends in the money supply, which is, well, how's the economy going? I mean, how much are banks going to lend? What does the money supply look like? They're trying to guess this. And the financial market is speculating on those guesses, which actually sets the direction of the economy. So this part here makes people feel wealthier, so they transact more, which makes the banks lend more money, which makes the bankers change their interest rate policy, which makes the financial experts try to predict where the banks are going to go, and they all feed on each other. It's a complete mess, and really, nobody has a clue how interest rates are actually set. And of course, in America, this completely ignores the euro-dollar market. What is the euro-dollar market? Is dollars created outside the US? Wait, how are dollars created outside the US? I mean, isn't the mint the only place which can actually print the dollars? No, because these are virtual dollars, not physical dollars. The way it works is, this started after World War II due to the Marshall Plan. Dollars were circulating in Europe because of all the American troops over here, and they were deposited in banks which are not regulated by the US. So the offshore banks lent these dollars, and it created a parallel capital market. And it kept growing because the loans and deposits were made in euro dollars, not those controlled by the Fed, because there's no money here. It's all virtual accounts being transferred from people to people. US banks lobbied for less regulation. Fed largely ignored the offshore dollar creation. And today, 64% of the US money supply is outside the US, right? The Federal Reserve doesn't have control over its own money supply. The US does not control, and this is true of most countries around the world because of all this virtual money sloshing around. So why do we have so many crises? Well, one reason is people who seem to be in charge of money are not really in control, right? Central banking has a lot of ceremony and a lot of theory, but it's run by regular humans. So we have credit cycles that affect things like mortgage prices, but they're not based on rational economic decisions. They are influenced by group behavior, by emotions about how the economy is going to grow. For example, lots of news articles today about the US economy being the wonder of the world. They're growing faster than any other economy before, but people are feeling incredibly depressed at the way the economy is going, which is why apparently Trump has taken a lead, or Kamala Harris. Right? Well, that's the problem here. So the rational economic decisions are being made on feeling. Right? So money supply is less stable than it appears, and it's affected more by human nature than by economic theory. So to conclude, life used to be simple, right? Everything was personal. Contracts were mostly implicit. Of course, we also had terrible teeth, we had bad diets, and we were very poor compared to how we are today. So I don't think I want to go back to that world. But today, nobody knows anybody. All our contracts are explicit. And every contract is trying to solve a problem. We're trying to solve the problem of deposit insurance, so you impose restrictions on interest rates. You try to solve the problem of interest rate, you impose restrictions on assets. You try to do things to solve the problems created by the previous contract. Unfortunately, this means if you have an error in writing a contract, someone's going to take advantage of it. Next time, I'm going to spend a lot of time talking about companies and companies dealing with each other and with us. And it's all about contracts and how you can find errors in contracts and how you can try to take advantage of it and how people do take advantage of it. So even if you have no errors, people can still take advantage of you if you don't have enough information or less informed than your counterparty, or you make mistakes in processing that information. And that is it for today.